Hey everybody, Tom Gentile. I want to welcome you all to my Tom's Trading Essentials webinar series. This is our summer series. We did one of these earlier in the year, and I am very excited to be back. Jay Harris is with me. Jay, good evening.
Good evening, Tom. Excited for this session. Summer months.
Hey, I call it summer months
Just
because,
make some money in the market, right?
yeah, and this weekend, to me, I mean, summer starts what is the third week of June, but to me, summer really officially kicks off this weekend, and so want to welcome all of you. Thank you all for coming in and spending the next hour or so with me. This is going to be a 3-week event. We're actually going to do this over 3 weeks. I want to welcome all of our Optionetics students. Thank you guys for coming in. I hope that that I make this not only tonight, but the next 3 nights educational for you, because that's the main goal here, is to get educated. And I'll get into everything we're going to discuss here in just a moment or two. But I wanted to say hi to all of you. Some of you, you've been around for years and years with me, and thanks for coming back in and spending a little bit of time. And those of you that are new, I want to welcome you to all of our new students. This is our educational portal, and what we do here is through tomsoptiontools.com and tomstradingroom.com and tomgentile.com, we do a lot, mostly free education is what we do. And so we're going to be discussing a lot of education over the next 3 weeks. Let me give you the rules as we have started. This session is being recorded. We will get the recording out to you as soon as possible following the live event. All right. Also, I'm going to say it right now. I'm going to apologize ahead of time because I am not going to be able to get to as many questions as there's going to be coming in. So, Jay, I'm going to need you to moderate and give me the most popular questions. We will try to answer. We'll try to answer as many as we can, as we do on these events. And then finally, let me mention this too. I have put for those of you that are here live, I have put under the handouts, I've got the slide deck. All right, so I've got the entire slide deck for tonight in the handout section. I made it a PDF, so you can download that. I will also email that to you with the recording later tonight if you can't figure out how to download that. But just realize it is available now and it will be available later. Finally, the disclaimer that you see on the screen here. We make this available at every one of our Optionetics Tom's Trading Room events, and you can read this in its entirety on the recording. All right, all you got to do is just hit pause. Couple of points I'm going to make. Stock and options trading has large potential rewards, but also large potential risk. I like to say this that buying and selling stocks or buying and selling options is easy, but making money is not. All right. And so to me, what we do, myself, Jay, and everyone else associated with Optionetics and Tom's Trading Room, what we do is we try to show you what it is that we do, all right, as rules-based traders. Now, rules-based trading is not 100% either, but what rules-based trading does is that it allows you to pull the emotion out of trading and therefore giving you a much greater chance of consistency and consistent results. We got a lot of students in here that have taken just a small piece of what it is we've shown them, and they've gotten really good at it. All right. I like to say be a jack of all trades, but become a master of one or two. And then you can then tweak some of the stuff that we teach you and really understand it and become that master of that particular strategy. So that's part of this. The other thing I want to mention is that myself, Jay, everyone associated with Tom's Trading Room and Optionetics, we are here as your educators. All right. We're not personal investment advisors. We cannot give personal investment advice. Can't do it. All right. But because we're in this venue right now, and I'm talking to a group of people and not one-on-one, I am able to educate you as to what it is that we do. All right. You need a broker to trade with. You must meet certain requirements, and everything I'm going to talk about tonight is in US dollars unless noted otherwise. And with that, let's talk about what we're going to cover. So a little bit about me for those of you that are new. I've been doing this over half my life, and the majority of you in the room tonight know because you were Optionetics students that myself and my partner George Fontenhills back in the early 90s founded Optionetics. Since then, I have authored several books. I appear on TV regularly, typically CNBC and typically CNBC Asia, because that coordinates very well with my schedule. All right. Also the founder and editor of TomGentile.com, Tom'sTradingRoom.com, and Tom'sOptionTools.com, which we'll be using tonight to look at live case studies. All right, I want to welcome all of our students back and our new students. I offer special education webinars beyond this trading essentials piece. I'll let you know this. The last one that I did was just a couple months ago for the entire group that I have, and we did a webinar called opportunities in energy, or energy opportunities, and that was back in mid-February. And I'm actually going to be bringing up those case studies tonight and next week as education to how we trade calls and how we trade spreads, etc., because those really did turn out great. I mean, I got to tell you, they didn't come out of the gate. If this was a horse race, the energy markets didn't come out of the gate, the ones that we were looking at that time with the other horses, but boy, it came from last and ran around the track and just blew away the competition. We'll show you that as well. If those of you that are OptionX students that are just joining me for the very first time, so you used to use something called Platinum. We used to talk about the OptionX Platinum software. That's been upgraded to Tom'sOptionTools.com. If you've never seen this, we do have a free trial available, and you can go to Tom'sOptionTools.com. And at the top, click on the free trial, and it's a full free trial. And we'll talk about that a little bit later too. And I do offer, along with my group, some premium education, and we do this on a limited number of students each year with different products. Each one of our mastery programs is offered once a year only. All right, we do partner programs, which are a big bulk amount of advanced trading. We do those once a year only. All right, so just want to make sure you're aware of that. We'll talk about that a little bit later as we go through too. So this webinar is, it's a group of webinars, 3 weekly webinars from 8 until around 9. I might go a little bit later. I don't want to rush this. So if you're willing to listen to me longer than an hour, I am happy to talk for longer than an hour. Our recorded sessions are made available. They're emailed out to you following the live event. And then, of course, the slide handouts I talked about are made available at the live events, and you'll get them by email. So tonight we're going to talk about what I call stock selection, all right? All about calls, all about puts, trading DarkNet, and we're going to get into money calendar. So we're going to do a lot tonight with spotting opportunities. Next week, I'm going to do a review. We're going to talk about spread trading. I'm going to get into cryptocurrencies a little bit, not much. And we're going to talk about other money patterns, all right? Again, we're looking for repeatable patterns. That's the whole purpose of what I do in terms of spotting opportunities, all right? Spot opportunities, create the low risk trade, and then plan, execute, and manage the trade. And that's what you're going to hear from me over the next 3 weeks. Week 3, we'll do a review of week 2. We'll talk about trading earnings reports, and my guest, Mike Wade, will be joining us as part of that session. All right? So let's talk about creating a stock list. So there's roughly 20,000 plus stocks out there in the universe. Okay? How do we dial that down to a workable list? Well, I like to look at 3 different areas. Market liquidity, looking at stocks that have a lot of volume. The more volume, the more the crowd is engaged in that particular stock, and therefore the better the bid-ask spreads are, okay? Not only for the stock, but for the option as well. I like to look for stock mobility. That means I like to see stocks and get involved in stocks that move around a lot. And then they have to be short-term optionable, because I'm more of that kind of trader that's a 30-day or less guy. I'm the income trader out there. I do some buy and hold, okay? But the majority of what I like to do is income 30 days or less. So I look for short-term optional. A lot of my trading has become 1 week or less. So for market liquidity, what we can do is, if you want to find the greatest liquidity out in the stock market, then go to the options market first, because if it's an optional stock, it's got to have some decent liquidity in the stock itself. So you can go to the CBOE, cboe.com or cboe.org. And what you're going to do is you're going to look for something called the penny pilot list. This is something that I look at. I update it regularly. It's a downloadable list of stocks that have options, bids, and offers inside the 5-cent spread. It means that these options are liquid. So no longer do I look at 4,000 optionable stocks. I've dialed that list down to, I want to say it's less than 400, because those 400 stocks all have something in common. They're all part of the penny pilot list. So what you could also do is, if you go to Google and you type in penny pilot program, what's going to happen is you're going to get a whole bunch of results. The very top one will say CBOE hybrid penny pilot program at cboe.org. If you click on that, all right, you click on that little link there, it's going to open up the CBOE website, and you're going to see a little area that says penny pilot program, and then you can click on the link below, and it will give you a downloadable list of the stocks that I use. All right, it's fantastic. It's very quick. It'll give you that list in Excel, and then from there you can then bring that list and actually make it yourself. You can make it even smaller. All right, you can rank those lists. If you know how to use Excel at all, you can rank those by stock price, and that'll get rid of some of the smaller dollar stuff, because I'm not a big fan of stocks below $25 a share. There's an exception here or there, but I like stocks to be above that, and really above 50 and 100 for some of the trading tactics that I like to use. All right, but it all starts here with the penny pilot program. So to take your stock list from 4,000 optionables to 400, to me, it's the top 10% of all optionable stocks. What I do is I incorporate the penny pilot options, and what I'll do is I'll go back and look and find which of these options have weeklies. All right, so that will take that 400 down to around under 300. So about 70% of the penny pilot program, the penny pilot options, about 70% trade weeklies. And that's what I really get my list down to. So why do we trade options? I get this question all the time, especially from folks who never trade options before or are brand new. Well, there's 3 reasons. Number 1, control, because what I'm doing is I'm leveraging options to take a bigger piece of a stock trade. You know, I was going to come on tonight and say tonight's webinar is sponsored by Amazon, because I had a trade on Amazon today. It did very well. All right, and I might actually end up doing that with every webinar I do. Is depending on what I'm doing that week, I might throw that little anecdote out. But yes, so what I was doing with Amazon was I had control. I had control with a high probability option trade through leverage. Okay. Also, options, particular types of options, offer protection, because the protection is that in some cases, the cost of the option or the cost of the spread, which we'll talk about next week, does significantly reduce your risk. All right. Let's talk about another trade. Quickie trade I had about a week or 2 ago. I was in Nvidia on a short-term trade, and I was happy. I mean, I lost money on it. Okay, I lost money on the Nvidia trade. All right, full disclosure, I'm not 100%. I don't claim to be 100%. But the stock went down a whole lot more than my option trade did. So that's where the protection comes in, because options can only lose on the debit side. If you're on the long side, you're only going to lose a certain amount. All right, a much smaller amount than the stock could slide if you're wrong on the direction. And then, of course, there's other ways you can use options to pay for protection, where you can offset options, not just in bullish and bearish spreads, but also neutral as well. All right, we're going to discuss that on week 3. So there are 2 types of options, and I broke this down, and I want to make it as simple as possible. But calls basically give me the right to buy, all right, and puts give me the right to sell. And we could get into the long, Wikipedia definition that calls give you the right but not the obligation to buy specific stocks at a predetermined price anytime prior to the expiration of the option. Yes, but what I try to walk away with is remembering, if I buy a call, I have the right to buy. If I buy a put, I have the right to sell. Buying calls is bullish, buying puts is bearish. Now, I could flip-flop that, and I could say that if I sold a call, I'm obligated. If I sold a put, I'm obligated. If I sold a call, I'm bearish. And if I sold a put, I'm bullish, right? But I don't want to go into that just yet. I want to talk really from the basics, right? Now, let's talk about a case study. We're going to talk about calls for a moment. So we got this case study with XLE, all right? Now, some of you might say, that XLE case study, I kind of remember that. Where do I remember that from? I'll tell you where you remember it from. Because the last big event that I did, we had this as a case study just a couple months ago. And we actually had several case studies in the oil and energy markets. I'm going to show you tonight one of these. I'm going to show you where all the rest of them are. So I'm going to give you a report you can download if you want to for the rest of these. But keep in mind, we started with XLE. So at the time, XLE was at $68, right? I'm taking you back to our last event that we all did together, $68. We did this oil and energy opportunities webinar. Some of you made it, and some of you didn't. So at the time, we were looking at a pattern in the market. All right, we were looking at an oil pattern from mid-February to mid-July. Energy typically heads higher. 13 of the last 15 years, I believe this pattern has worked out. And of course, here we are. You can see what's happened prior. This is the beginning of the year, and XLE was at 78 and dropped all the way down to the low 60s. We had a target between 75 and 80. Let's call it 77 and a half. Really pretty close to where we were for the highs earlier in the year. So we're looking at XLE, it's at $68. Now, I can buy options on XLE. So some of the questions that those of you that are brand new have got to be asking is, how many options can I buy at $68 a share? Well, that's called your contract size. I'm going to get into that. Can I buy XLE options at different prices other than 68? Yes, they're called strike prices. I'll get into that. How much time do I have on my option? That's called your options expiration date. I will cover that third. First, option details. All right. How many shares can I buy at 68? Well, these are called option contracts, and each contract is good for 100 shares of stock. So that's why I like to start off saying 1 equals 100. 1 equals 100 in the United States, 1 equals 100 in most countries around the world. There are a few countries where 1 equals 1,000. That's a lot of leverage. But where 1 equals 1,000, most of the stocks are very, very cheap. So you need more leverage to entice an option trader. Not here in the US. Options trading in the US we have the greatest volume in the world in terms of options trading. All right. Countries outside of the United States love to invest in US equity options and ETF options because this is where the volume is. And so for here, and with every option that I trade, 1 equals 100. That means one contract is good for 100 shares of stock. So you got to keep that in mind when you do the math and you create your trade. All right. Next, your option details. So the strike price, $68. All right. That means the price the buyer can exercise that option contract for. And then finally, you look at the expiration. So expiration dates. And with strike prices, you can look at various strike prices up and down that cycle. And we're going to look at those with XLE. So most people understand expiration dates the third Friday of the month. If you're an old school option trader, that was always the date we looked at, the third Friday of the month. But now we have weeklies, which expire every Friday at 4 p.m. We now have Wednesday options out as well, and Mondays, and EOM options. Those are end of the month options. And we have quarterlies, and we have leaps. We have all kinds of options in between. So there are a lot of expiration dates to be aware of. Which are best? Okay, I'm going to tell you which ones are best. The old ones are always going to be the best. The third Friday a month has the most liquidity in it of any option. So options that expire the third Friday of each month, that's the ones I'm looking at the most. Then I look at weeklies. Those are the options I trade. Third Fridays, weeklies. I'm starting to trade Wednesdays. I didn't trade Wednesdays for a long time because I want to be a small fish in a big pond. I don't want to be the first one to step up to the plate and trade a Wednesday option. I don't want to be the first one to step up and trade Monday options. All right. I want someone else to go down that road. Someone else go down there. You know what? I'll stand back. I'll wait till I see things working out before I get involved. And it could be a year before I jump into something like that. So just remember this. Fridays are good. That's what I'm trading. That's what I trade most of. All right. So a couple definitions: in the money, out of the money, at the money. What do these mean? In the money options are options that have real value. An in the money call option is a call option where the strike is below the actual price. That's where it has real value. It's in the money. Out of the monies are options that are away from the strike, the price of the underlying security. So think of an in the money option with XLE. If XLE was at 68, a 65 call would have 3 points of in the money value. All right, an out of the money call, maybe that's a 75. If XLE is at 68 and I have a 75 call, then it's out of the money. It won't be an in the money option until XLE trades above 75. And then at the money are where the stock and strike prices are the same, but it still doesn't have any real value. Okay. Volatility is another piece that we need to think about with options. Volatility is the speed of stock relative to its time. Right? There's two types of volatility that we use in predicting stock movement. And when I say predicting stock movement, I'm not talking about predicting whether stock's going up or whether it's going down, but what is the predictability of the range of that movement? There is statistical, which is based on what the stock has done in the past. And then there's something called implied volatility. Implied volatility is built into the time value of the option you're trading, because that gives us a clue as to where that stock may fluctuate up or down between now and its expiration day. Now we're going to get back to XLE here for a moment. So I've got my stock chart of XLE. And I see that, what it's done, but I also know that I've got, and technically we could look at this and say, oh yeah, it's come back a whole lot, but we've got a potential bottom in here, right? And you might be looking at these lines wondering, what do these lines all mean, Tom? Well, these are what's called stock chart peaks. And stock chart peaks are something that we created and now have available on our tools. So we got a rounding bottom happening here, potentially support. We've got the equilibrium area, which is in between where our last resistance and support is. And then, of course, we've got these areas of resistance, which are part of stock chart peaks. So we've got some really good vibes that technically we could come up and we're going to find resistance in these particular areas here in the future. All right, so that's what we're looking at. Now, I'm going to do a side-by-side comparison. What if I were to go long shares of XLE at $68 versus the XLE call, which I'm going to show you exactly what we ended up doing. Now, the XLE shares are going to cost me 100 shares at $68 a share, $6,800. That's my cost. That's my risk. And I know the risk is very, very low that you can lose all $6,800. But as a long-term holder of stocks, there are some people in this room that may have been involved in Enron 10 years ago, that may have been involved with Bear Stearns, okay, or any of the other stocks where they were too big to fail until they weren't. Okay, Lehman Brothers, it failed before anybody pulled the plug on the other bank stocks and broker stocks and kept them from falling. So we have seen stocks that have gone to zero and it's been game over. So when we look at overall absolute risk, we have to look at what the risk is to zero. The call options, and the particular 68 call we were looking at was past summertime, costed $432. So the risk was $432. Okay, break evens on a stock, wherever you bought the stock, that's the break even. Wherever you buy your option, break even is calculated as the strike price plus your premium. So on this particular day, the break even was $72.32 at expiration. That's the 68 plus $4.32. You also have profit potential. So we discussed the risk. What if I'm wrong and what if I'm right? Well, let's take a look at 77.5. That's right between 75 and 80. 77.5, you'd have had 9.5 points if you were the stock buyer. That would have came out to about a $950 profit on $6,800 risk, or a 15% return on investment. The call option at 77.5? $518. $518 on 432 risks. That's 110% return on investment. The reason I mentioned 77.5 is because just a couple days ago, XLE hit the 77.5 level. All right. So I'm going to show you that. And here's the details of the actual option trade that we discussed back in February. So you can see here, here's your option trade in February, and there's your bid and offer, and there's that mid price at 432. And I was looking at these at $5 or less at the time. And so from there, we were looking at this particular type of graph. If XLE dropped, then the total risk we have involved is what we paid for the options. But look at the upside. The upside is unlimited until you exit the trade. All right. So that's what this risk graph looks like. And I look at risk graphs on every single trade that I do. Now, trading puts for profit is no different than calls. You just have to switch things up, meaning that puts make money as the stock goes down, but they have the same 1 to 100 contract size. They have the same number of strikes. They have the same expiration dates. The only difference is they increase in value as a stock price decreases. Okay. So let's at this point stop for a moment, and I'm going to slide over and I'm going to go to tomsoptiontools.com. So I'm looking at the front page of tomsoptiontools.com, and those of you that are brand new, if you log into tomsoptiontools.com, right up here you can click on free trial, and that'll take you over and you can look at all the different products that we have, and these are all free trials if you want to check them out. All right, and just click on that and you can get all the details. So back to tomsoptiontools.com. I'm going to go ahead and log in. And what I'm going to do is I am going to take us back, because one thing we can do here is we can back test. I'm taking us back to 2/15. That's February 15th. That's when we did our last big webinar together. So I'm going to click on the go button. This is going to take me to the 15th of February. All right, now what I'm going to do is I'm actually going to go in and I'm going to look at, I'm just going to pull up an option chain. And I'm going to pull an option chain up for XLE. So I'm typing in XLE. Let me open this up so we can see this a little bit better. All right, so here's my XLE. Now, I was looking at a trade that went all the way out to summer. So you can see all the expiration dates. You can see all the strike prices for those and what our days are to expiration. So if I'm going to take a trade that's out in July, I got to go past June. The next area was September. So we're going to look at the September options. They had 218 days to expiration on the date that we did the Energy Opportunities webinar. And let's take a look and see what we have. So there's the stock price, $68.27. All right. The 68 calls at that time were 450 by 460, so they were below the $5 level that we were looking at. So let's just take a look at buying one. So I'm going to put one in there, and I'm going to click on risk graph. And you're going to see the same risk graph, roughly the same risk graph, maybe $30 difference. And there's your risk graph. See, look, here's the XLE that came down. Here's our area. Here's our risk graph, and it shows what we stand to lose if we're wrong and what we stand to make if we're right. Okay, now the red line represents where we are today. So the clock's ticking, but I'm going to show you how we picked this a little bit later on here in just a few minutes. You can see how this moved higher. Okay. At this point, let's take a look and see what this has done since then. So this is the area where I go in and I start to look and see the what if. Now I can go plus a day, plus a day, plus a day, but that's going to take a while. Let's go plus a month. Let's go look and see what happened by March 15th. Look at this. We're down $135 on the position because, and I told you this, that XLE didn't come out of the gate. This wasn't the horse that came out of the gate like oil drilling stocks did. So that is, again, 3/15. Let's look at April 15th. See what April 15th did. Okay, now we're up $178. Now it's moving in the right direction. Look at the stock. It broke out of this area, this box we were in, and started moving higher. All right, now let's look at May 1st. So I'm going to change the dates to May 1st. I'm going to click on the go button. Now we're up 51% on the trade. All right, this was May 1st. Let's look at May 15th. And we're moving along. I'm just showing you, and I could go day by day by day. 119%, folks. 119%. That was on May 15th. Now, if I go forward, I can plus a day, and I can see what happened. 123% on May 16th, 147% on May 17th, and it just continues to go. Where are we at today? Click latest. That takes me to today, and it's actually dropped back a bit. And you can see what's happened here is it started to pull back. So when do you get out of a position? I get out of half of the position if it doubles in value. This doubled in value a couple weeks ago and then got better. Now it's dropped back a little bit since then. All right. And so I wanted to share that with you, but this is a great example that anyone that came to our Energy Opportunities webinar, we gave this out as a trade, one of several. And so I want to make sure that you're aware of that. All right. But also how call options work. Now, this could have went the opposite direction. And the opposite direction is, what am I willing to lose? All right. For me, I won't put a trade on that has more than $500 in risk in any one contract. All right. So keep that in mind. That's what I look for. I look for that low dollar risk. All right. So that is XLE. That's the option. Jay, going to bring you on here for a second. Do you see any questions that are coming up that have to do with what we've discussed so far?
If you want to take a stab at the question about putting in a limit order, if they put in a limit order and the price on the open markets are less than that limit when they're buying to open, how does that work? Are they obligated to that limit, or can they get a better price?
Oh, no, absolutely get a better price. So for this example, and if I back up here, this was a trade. This is an example where, we're looking at putting a limit order in at, let's back it up here, at $5 or better. If it opens at, let's call it 440 on the ask, and you'll get filled 440 on the ask. All right. So keep in mind that a limit price is at or better than what your expectations are. Now, that being said, if this opened at 550, you would not get filled at 550. Your order would stay intact, and it would stay as an open order until you got filled. All right. I had some open orders out on SPY options today. They did not get filled. So I didn't lose anything other than opportunity, but tomorrow's always the next day. That's the great thing about the markets. There's always something out there that you can trade. But when I say that, I want to also say that I don't go looking for trades. I need trades that come looking for me. I need a trade. I need to see a reason why I want to take a trade. And it can't be because I think it's going up or I think it's going down. And that's actually a good area that I could segue into here. Jay, anything else that you see that we need to discuss?
Multiple questions about the XLE butterfly. I don't know if that's too much you want to get into now, or if you're going to show that to them later or in the subsequent week.
Yeah. I mean, we discussed calls. We also discussed a call spread. We discussed a butterfly. So, I mean, I'll bring it up real quick. We're going to talk about call spreads next week. With butterflies, remember, butterflies are an option where you're looking for a particular target. Now, I knew putting, that looking at all of these and trading all of these, that you're really more slanted toward the upside. So the calls make money and the call spreads make money, and we'll show you call spreads next week. But a butterfly is more geared to a particular price. Now, the great thing is that I'm using September options. So it is my expectation that we're running up and we're now starting to take that turn. And, I still think we might see some more upside with XLE, but to me, the upside pattern's over by July 4th. Then going into the rest of July, going into the rest of August, going into September, I'm expecting XLE to slide back right into the body of that butterfly for those of you that were asking. That's my expectations based on seasonality and based on the pattern. So I'm in for the long term on the butterfly, and the butterfly really hasn't dropped that much. We're talking about a trade that costed less than $1 to put on. I mean, this thing was pennies. And so there's not a lot of risk out there, but the reward is enormous. But with butterflies, you gotta stay in. That's a maturing trade. That's a trade that matures into the last month of its expiration. I knew that going in, and so far things are playing out exactly the way I expect them to. So we discussed all about calls and what we look at with call options. We discussed puts. And now what I want to do is, and we even use an example. So I want to start to spot some opportunities tonight so we can actually look at some stuff going forward. So I'm going to be going into DarkNet and Money Calendar. I'm going to show you both of those, and we're going to look at call and put option opportunities in DarkNet Money Calendar. I'm going to tell you right now, I have not prepped anything. All right. The only thing I might have prepped is I got some slides ready, so I got to make sure I don't forget something. But I have not gone out and did any scans yet, guys. I decided to save this event for all of you so we could all look at this stuff together. Again, the whole premise is spot the opportunity, whatever that opportunity is, all right? Whatever rules-based trading system you use that's what you want to use. I'm not going to be going through an opportunity saying I think something's going up or I think something's going down, all right? Thinking doesn't work for me in trading. It just doesn't work. I need to have some sort of objective trading rules, all right? So spot the opportunity, create the low risk trade. That's where we'll use options, plan, execute, and manage. So let's start off with DarkNet. So let me give you a quick little rendition of DarkNet. So DarkNet is what we call our contrarian trading strategy. It's similar to Elliott Wave because we use channels, all right, and not wave counts, but we use channels, which are very similar when we're looking at trending channels or trending waves. Now, where it differs from Elliott Wave is that the signals are steadfast. They're not changing all the time. Once I get a DarkNet buy, it doesn't change. It's there, win, lose, or draw. And it is a buying only strategy. So this is perfect for talking about calls, right? So we'll look into DarkNet and see what's going on with it right now. The buy signals look like this. This is a chart over time, and you can see a buy, and then we have a sell signal. Here's a buy, and here's a sell a couple of days later. That didn't do much. And then there was a buy signal over here more recently on the chart. So what's going to happen is when I bring up active DarkNet signals, I'm going to see all the stocks that have met a DarkNet signal. And I'm going to have one of three particular types. I'm going to have a B, which is a buy. I'm going to have an R, which is a rebuy. And then rarely, but I will get them every once in a while, I get an A, which is an add-on. So basically that's buy is the first signal, rebuy would be a second signal in the same stock, and an add-on would be a third. So I want you to think about that when you go in, that, you know, if I'm looking at risking, for instance, $500 on a trade, realize that there's a potential I might have three signals there. Okay, doesn't mean I need to take them all. Just realize that that's a potential. But DarkNet is has a high historical probability of being right because it's channel technology, and what we're using is we're looking at channels, long, short, and intermediate term channels that are colliding, and this creates a potential 20 to 30 day trading strategy on average. So let's look at some case studies. So I've got DarkNet all kind of set up and ready to go. So what I do here is if I go into, for those of you that have our tools, if you go into home and you go to Tom's tools, and you're going to see option trader, which is where we do all of our risk graphing, right? But come over to DarkNet and click on the options analysis DarkNet channels. And when you do that, you're going to get DarkNet signals that pop up. Now, it shows nothing. It's because you have to click on the search button, and you might want to change a few things around as to what, you know, search filters you're looking for. Whether you're going to look at all DarkNet stocks or something smaller, what does your slippage need to be? All right. So for me, my slippage, I like my slippage to be 1.0 or less. Okay. And you know, this is fine right here. We'll go ahead and look at maybe changing a couple things around, but 1.0 or less will give me those stocks that have just the best amount of slippage. Here we go. So there's 13 of them that popped up. And you can see here, all the slippage was below 1.0. It's fantastic. So of this, what I like to do is I like to go through and I like to look at charts because I'm looking for higher lows and higher highs. I want something that's moving up that is pulled back. That's what I want. All right. So if I look at something that has an R in it, I know that's a rebuy. For ULE, that's the ultra euro. Look what it's doing though. It's going down. All right. The computer can't tell me you know, whether I'm in an uptrend or downtrend when we're looking at channel collisions. It just knows that those are happening. Floor systems, I can look at. This is an example of a stock that not only is creating higher lows and higher highs, but it's had signals in the past. It had a buy at 46 and a sell at 48. It had a buy at 46.5 and a sell at 52.5. So it's not only moving in the right direction, but it has past profit potentials. So this is a great example of a DarkNet trade. All right, Fleur Systems, FLIR. All right, I brought that one up, and then over here it gives you an actionable stock you could look at. And again, this is something that you might look at and say, well, maybe this isn't what I want. The 55 call, I could just click on this, and I can see what this 55 call is going for, 85 cents or $85 for a contract. All right. Where are we looking for it to go? Well, we're looking for it to get up here, at least in the outer area of this blue band. And that blue band does make it profitable today, tomorrow, next week. You get to 0 days to expiration, though, the time value decays out of it. So it's really going to need to get up into this area. All right, the extremity of this channel that we see here, this standard deviation channel. And that'll put it at a double. All right, but that's Fleur Systems. Okay, let's look at another one. Let's see, 3M. I'm going to move down the area real quick. We got so many good ones. What I could do is I could look at just the most. So how about 0.2? That's going to show me just the ones that have the best slippage out of the entire group. We're talking about 4 of them. 3M, Fleur Systems we looked at, but 3M, NetApp, and Sienna. Right, all have 0.1% slippage. This just means that the bids and offers on these options are the tightest of the entire scan. 3M, let's take a look at it. Now, does that look like something we want to jump into? It did have a buy and a sell that made money. It did have a buy here and a sell that made money, but it's moving in the wrong direction to me. How about NetApp? And NetApp is moving in the right direction. Higher low, higher high, higher low, higher high. Okay, winner, buy at 56, sell at 54. Winner, buy at 59, sell at 68. Buy at 66, sell at looks like 70.5, and a buy today. And look at that big swing up today. That's a nice bullish move off of the day after earnings with NetApp. So this is a great example. And let's go ahead and take a look at. Let's look at Sienna one real quick. And Sienna even looks good, right? Take a look at the past signals. Buy, sell higher, buy right here, sell a little bit higher, buy today. All right, but I want to look at NetApp. Just look at it for some further information. The June 15th, 66.5 calls, trading for $2.71. All right, so let's take a look at that one. And we see that it has a 65 delta. That means 65% of this option. Well, what it means is that for every dollar move in NetApp, we're expecting about 65% of that move to happen in these options. Okay, that's based on today. Tomorrow, that number is going to slightly change. But there you go. There's your risk. Here's your potential reward. And you can go back and you can look at something like a NetApp and see that, what kind of moves has it had in the past? Well, this was a 50, you're talking about an 8-point move. Here's a 10-point move. This is 66 to 70, about a 4-point move. So 8, 10, 4. So let's call it 6 points on average. So when I look at that and I look over here and I say, all right, here we are today. Where's 6 points? If this is 68, that puts us at 74. So 74 is somewhere around here. If that's true, then we're talking about something that could double in value. So of the stocks that I'm looking at tonight with this particular DarkNet trading strategy, I like this one. So I'm going to go in here. I'm going to put in Tom's Trading Essentials May. So I know May 18. And I'm going to save this chart. And we're going to follow up on that next week and the week after. All right. So that's NetApp. Now, another way that we can look at this. In fact, you know what? I'm going to stop in just a few minutes. I'll take a few questions. But, well, here we go. We're going to take a few questions now. Jay, any questions on DarkNet that you're seeing?
What's the D on the chart mean?
Dividend.
Yep.
Dividend. Thank you, Jay. So we have a couple of things that happen on these charts. And, honestly, there's a lot of good chart stuff out there. E is earnings. If the triangle's up, that means the earnings were above expectations. The triangle's down, they did not meet expectations. The D is dividends, and of course B and S are the buy and sell or bullish and sell exits on the actual trade. Now, and like I said, these never change. All right, these aren't something that just showed that just populated to make it look, ooh, boy, this is great. No, these have always been there. All right. And the way you can find out is that any of you that have our software, or that you're taking a free trial, all you got to do is reset this back in time. Go back and look and say, this signal happened back at the end of the year. I want to go back at the end of the year. I'm going to reset this back to say 12/30/2017, and I want to bring DarkNet up, and I want to see this buy. And it's going to show it to you, and it's going to show you the buy, and then you can walk forward, it'll show you the sell, and you can see how the options did with this particular trade, or any trade for that matter. We have over 5 years of options data out there on every optionable stock, all right, up to 5 years. Some stocks haven't been optionable that long, but we carry that raw data, all right, something very, very few people have. So the next one I want to talk about is the money calendar. Now, the money calendar is a piece of software that we developed. This took years to develop, and we first made it available to our Optionetics group, the ones that hunted me down back in 2015. We made this available. And so what it does is that we look for short-term patterns. We use at least 10 years worth of data. All right, from there, what I do is I then look for option trades with those 1-to-1, 3-to-1, 5-to-1 reward to risk ratio. And this is something that we're in the process of being granted a utility patent for. And if any of you know how long it takes for patents to happen, we applied for this patent back in 2015, and we're at the point where we're at the stage where we should be looking for acceptance on this very soon. So we're very excited about that. But the money calendar has several different views, and for those of you that have seen this before, wait till you see some of the new stuff we've done, and I'm going to be sharing that with you next week. But the monthly view looks like this. It looks just like a calendar, and I can go in and click any day, and then I can actually bring up a set of stocks that are potentially bullish and bearish going forward. From there, I'll go and I'll pinpoint a stock, and I'll click on it, and it'll give me some more information, and that information will tell me how whether it's bullish or bearish. If it's green, it's bullish. If it's red, it's bearish. How long the trade is going to last. Gives me information like net profit, the accuracy of how well this pattern's done in the last 10 years, its average profit, and its end date. And then from there, we'll just get a little more information. I can see, wow, that pattern really, really jumped in the last 3 or 4 years. All right. From there, I'll go in and create the low risk trade. And I can go in and find, in this case, we were looking at spreads because these were just too expensive. But just kind of giving you an idea of what we ended up doing and how the money calendar works. All right. In this case, the stock increased over 5%. The options actually doubled in value, the option trade we were discussing on it. Now, how did the money calendar work with XLE? This was XLE back in February. So remember, we had a couple things happening. We had the longer term pattern, but we were also seeing shorter term patterns that were up to 85% accurate that XLE was going to take off over the next couple of months. And so that's what we were using when we were looking at XLE, not only the long-term patterns, but we were looking at the short-term patterns as well. All right, so let me show you, and we'll go through some case studies with money calendar. All right, so to get the money calendar, again, I go to Home, go to Tom's Tools. For those of you that have access and you have access to our Complete Trader, or you're looking at a free trial with Complete Trader, go click on Money Calendar. And look at all this other stuff we've added. For those of you that haven't seen some of the stuff we've done, we've got some fantastic stuff out here. We have the Money Calendar app, but we've got holidays. I'm going to be discussing that next week because we will be at a holiday. We got Memorial Day going on. I'm going to show you how we use that next week coming out of Memorial Day. We've got some clocks. We've got Money Clock. I've got something out here called Money Calendar Trader. We have now added cryptocurrencies. We're looking at patterns on cryptocurrencies. These just became available recently. And so we will have videos coming out for those of you that are our Tom's Tools folks on how to actually use these. All right, so they will be available. But what I'm doing is I'm going to look at the monthly calendar right now. Here's Monday through Friday. Each day I get a list of stocks that potentially hit the calendar and how many were bullish and how many were bearish. Now, May has not been a great month to trade, but look what's happening. We got a week where we got some green, right? And then we go back to red again. But eventually this pattern is going to change into June. And I want to show you that. Let me show you that now, and then we'll look at some case studies. So I'm going to click on May, and I'm going to go to June of 2018. Look what happens as we get past June 13th. All of a sudden, more green on the screen. And then once we hit June 22nd, then the patterns turn totally green as we hit end of June and into July. So the real bullish patterns aren't going to start bullish after bullish after bullish until next month. All right, want to make you aware of that. Let's go back to May. And let's look and see what we got happening today. So again, here's today, May 24th. I'm clicking on today, and I see a lot of green on the screen. Now, what I like to do is these symbols pop up, and then I can rank them by net profit. I can rank them by accuracy. There's a couple things like Micron Technology. My son trades Micron Technology. And one of the things he likes is he likes that 100% money calendar pattern. Jay, did you know that my son, his trading account is up 50% this year? He's
Way to
not
go, Freddie.
he is. He's not a. I mean, he's not a risky trader either. He's very,
Yep.
very. I mean, this kid is cheap. He's still using a computer from five years ago. I can't get him to buy a computer. I can't get him to buy a stand-up desk. I can't get this kid to buy anything. But he likes buying Micron. He's got a couple other stocks that he trades too. But he loves these really these high patterns that are going on.
And he's a kid, so he's not really fully engaged on it too. So to be up 50% with a busy lifestyle as a teenager, that's pretty impressive too.
Yeah. I mean, he's got college. He's still going. He's still doing. He trades cryptocurrencies too. So he's got that going on as well. But he really loves option trading. And I don't know where he's going to be doing after college, but he wants to do something in the quantitative analysis area. So I keep trying to hire him, but I don't know. He might be too expensive for me. Anyway, I re-ranked this. So what I did was I re-ranked this by what we call the power meter, and the power meter just tells me the level of success this pattern has had as we get closer and closer to today. So take a look at Amazon. 19-day trade between now and June 19th. This tells me that 8 years ago was the last time this pattern lost money. So if I click on Amazon, I'm going to get some more details. There's the buy. There's the day that it's done. Look at this. There's the reason why the power meter is so high. Because way back here in 2009, 2010, 2011, not much happened. But then the last 5-6 years, last year this pattern went ballistic. And I can click on that 2017. And I can see exactly what happened. Look what happened, 990, and then it dropped really hard one day, but it bounced right back. And that's where the pattern was, that was a crazy pattern. Again, why we trade options, guys. All right, but take a look here, $7.82. There's a move. But Amazon may not be the call trader's dream. So let's go back to view today once again, and let's come over. Let's look at our power meter. Let's see what else is out here. Aetna's out here. All right, let's take a look at Aetna. So AET, this is today to June 18th, 26-day trade. Oh, nice power meter. Look at this. Nice. The last 3 years have been fantastic for this one. Let's take a look and see what this pattern looks like. That's a nice pattern. That's not a volatile pattern. Let's look at 2016. Same thing. I mean, lift off, came up, we'll pull back a little bit, then advance forward. This might be a great pattern as a call buyer. All right. So again, what have we done here? We're taking a look at what's the bullish trades. Was there any bearish trades in the money calendar? We'll go back and take a look at that in a moment. I got my eyes on Aetna right now. So I want to look at Aetna. So I'm going to go to look at a risk graph. All right. Got to go back and I'm going to pull a risk graph up. Let's go over here. All right. So we'll take this. So this is today. I'm going to type in AET. I'm actually just looking at options again. I'm going to an option chain of Aetna. Now, let's go back and take a look at the money calendar once again. June 18th, somewhere around June 18th is what I'm looking for. Well, I know there's some options that expire on the 15th. All right. 16th, 17th is Saturday and Sunday. So the 18th is Monday. So I'm okay, coming up a little bit and looking at June 15th as a potential. So let's go ahead and activate the June 15th options. I'm going to click update and I'm going to come down and take a look and see where we are right now. So stock's at 177, but look here, the 175 calls are below $5. If I put a $5 limit in on this, this is a potentially good idea. So let's click on of 1. And let's go to the risk graph. And let's take a look at this one. All right. Now it's got some slippage to it, but if I put a $5 limit on this, that could potentially do something for me. Let's go back to Money Calendar again. Now, what am I looking for? I'm looking for that average move. And even though the average trade shows $3.21, that's based on the last 10 years. I'm really looking at what happened those last 3 years. We're looking at about 8-point move. So an 8-point move on a trade that cost me $5, all right, where could it go to? So what I want to do is I want to look at that risk graph of Aetna once again. And let's add 8 points to 175. That puts us at 183. At 183 on the chart, we're really sitting right around here. That's 184.92. Back it up a little bit, a little more. There's 183, a profit of $441.94. So almost a double, all right? And that's pretty good through the life cycle of this trade. Today, tomorrow, 22 days from now, because you're so deep in the money that that time value pretty much evaporates if the stock gets up above its highs that happened just, what was it, last month? So that's Aetna. Let's take a look at one more. All right, so I'm going to go look at, let's go to Money Calendar one more time. And let's look for a bear. I mean, you know, maybe not a bear today. Let's go ahead and go back to the month. And let's go to tomorrow. So tomorrow I have 58 trades, potential opportunities. 55% are bullish and 45% are bearish. Oh, I see some red on the screen. There's the red. But does the red come to the top when I click the power meter? Something did. VRX. You know, I remember this stock. Is that Valiant? Jay, is that Valiant Pharmaceuticals? I'm trying to remember. Oh, it's Vertex. Okay, so take a look at this. Now, this stock is a 21-day trade, and it's showing that it drops on average $4 during this pattern. So this, between today and June 14th, VRX has actually dropped more often than not. Now, last year didn't drop so much, only 11 cents. So I got to worry about that a little bit. Maybe there's something better. All right, so let's go back to the day. And again, I want to double click and bring the power meter up. Qualcomm, this is interesting. Let's take a look at Qualcomm. So Qualcomm is a trade that between May 25th, that's tomorrow, and June 27th. That's my birthday. Qualcomm has typically dropped. And look at this, about $2.50 each time. But this particular year, it dropped 7. That was 2015. Back to 251. This is a particularly convincible pattern year after year for Qualcomm. So the question is that we spot the opportunity. Can we create a low risk trade from it? That's the big thing that we want to try to do. So I'm going to go back to my option chain. I'm going to type in QCOM. And I'm going to see if I can do something here. Remember, spot the opportunity first. We may not be able to create a low risk trade. Here's June 29th, 2018. Right?
And let me amend myself, Tom. You were correct. That was Valiant, not Vertex.
Oh, it was Valiant. Okay. All right. So June 29th, let's just look and see, because it might, yeah, so $1.40 by 220, that's a pretty huge slippage. And it's because I'm using an option that's not as liquid as the ones that expire the 15th, right? When you go outside the 15th, things get a little less liquid. Just keep that in mind, all right? 140 by 220 is, I mean, that's an 80-cent spread. Maybe that's not so bad as long as you go limit in the middle. But remember, we're looking at puts. 192 by 273. Now, you know, we're still at the 80-cent spread here. So again, if the stock's trading at 59 and I'm looking at a $2.50 move and it's going to cost me $2.50 to get in, I'm basically, you know, I mean, you might get the 2.5 point drop, but you're going to lose all that money in time value. So we spotted an opportunity with Money Calendar. We just can't create the low risk trade because, again, I've got nothing but time here. And if the stock drops 2.5 points, I can't make anything. All right. So I want you to be aware of that. All right. Now, we could do something with this with spreads, but I'm going to save that for next week. All right. So there's our case studies. Jay, any questions with Money Calendar or any case studies we've talked about tonight?
No, not on Money Calendar.
Well, okay, awesome.
Well, I'm getting a lot of corrections of me for it being Valiant versus Vertex, and then there's a bunch of questions about the recording, and you've addressed that, and I'm sure you will as we wrap too.
Yeah. So VRX was Valiant. You guys are correct. All right. I guess I could say I was correct too, but I don't want to gloat about it. I mean, it's VRX as far as I'm concerned. But also keep in mind that the session, for those of you that came on a little bit late, is being recorded. All right. So let's just stop and get an idea of what we've done here so far. So we discussed how to build a stock list. All right. And again, and let me just show you real quick how you do that. So just go out there. Let's just go to Google. Okay. Not Google Maps, google.com. All right. And then from here, if you just type in penny pilot program, you can see it just pops right up there right away. And there it is, the very first one. This is all you got to do is just go to, if you typed in penny pilot program and you click search, click on the hybrid penny pilot program, and there you go. And that's what you want, that very first one. And it shows you when they add and replace classes, etc. I mean, I bring this thing up and I look at it about every 3 months, and I download that new list. And when you download that list, it's going to come in. It's going to come in down here as a CSV file, which is an Excel spreadsheet. And you just pop that Excel spreadsheet up, and it's going to show you all of the stocks that I look at. And what's in the penny pilot program as today? 396 stocks. Okay, it says 397, but remember the first line's a header. So 396 stocks out of 4,000 optionables are penny pilot stocks. All right, we talked about that. We talked about all about calls. All right, and I kept it brief because I know the majority of you understand what calls and puts are. But there's a few of us that are new out there. Okay, and so we talked a little bit about why I choose calls and puts, why I like to buy them. I do like to sell them too, right? And I'm going to show you the combination of that next week when we get into spreads. But we also discussed spotting opportunities, creating that low risk trade, and then finally planning, executing, and managing that trade. And that's where you go to your broker and you use your broker site. And your broker site is a great way. I used to call these orders in. That's old school. And there's several of you on here that know exactly what I'm talking about. I used to call orders in, and I got them wrong early on. In fact, what got me into contrarian style and rules-based trading? Because I thought something was going up, but I called the order in backwards, and then I made money on it. Crazy. That's when I realized, wait a minute, maybe there is something to this contrarian stuff. So we discussed, again, building stock list, all about calls and puts, and then looking at rules-based trading such as DarkNet and Money Calendar. For those of you that are brand new with us and you've never tried our software, go check it out. It's a free trial, and it's a free full trial. It's not a partial trial. It's a full trial to our option trader or DarkNet, a contrarian trader, or our complete trader. All right. Be sure to check those out. Your homework is I'd like to follow these case studies we discussed tonight. If you want, you can go into tomsoptiontools.com. We have videos on how DarkNet and Money Calendar work in detail. All right. And of course, free trial for those of you that are subscribing. Next week, what I'm going to do is we're going to get into a review of this week. We're going to talk about the homework and see how these trades are performing. We're going to get, and by the way, this is not going to be easy because we've got two bullish trades, and we're in an area right now where the market's really kind of, this is a trader's market. This is not a buy and hold market. So I'm going to be curious to see how these trades do going forward. But we got a lot of objective rules on our side, right? Next week, we'll get into vertical debit spreads. We'll talk about how to trade these high dollar stocks in the summer. And I want to show you money patterns, including cryptocurrency. So we're going to be using other money patterns as ways of spotting opportunities. Again, to create that rules-based trading system that allows us to trade options on it. All right, guys. So that is it. You will get the recording soon. You will get the slide deck along with that recording. All right. And I hope to see all of you here next week as we get into this even in more detail with more case studies. And I look forward to seeing you guys all next week. Thank you very much, everyone. Have a great night, and I'll see you soon. Bye now.